Well, the jobs report for March is in, and as usual, the devil is in the details. So you had a headline number, 236,000, which is in line with consensus. But here's the rub, folks. Only 189,000 of those came from the private sector. So even the so-called whisper number, it missed that. It was far below that. Here's the thing. The report actually corroborates certain things we know. The slump in manufacturing, issues within construction, and now fading free money, even on a local level, as 480,000 Americans hit the bricks to look for a job. The knee-jerk reaction sees equities a little bit higher, bond yields higher, a shift now to 66% chance that the Fed's now going to hike rates at their next gathering. And that's based mostly on the unemployment rate. But I got to tell you something, flat wages, a slowing work week, a spike in folks looking for work, I think that should give Jay Powell and company some comfort. Joining me now to discuss, Bianco Research President Jim Bianco. And Jim, taking today's report and all of the data that we've seen this week, how are you modeling now the economy and the Fed, not just for this next rate hike, because that may be a 50-50, but for the rest of the year?
Yeah, I think that the economy's in a state of uncertainty and flux. A month ago, I was in the no landing camp. The Fed's going to probably move to 6%. Inflation's going to be sticky. But now we have a banking crisis, and that banking crisis could really upend the economy between now and the end of the year. And it all depends on how big and how broad this banking crisis is. And right now, we don't know. So that's the focus, is how big is this? If we are having a banking crisis, what will make it worse is if the Fed starts raising rates again in May and even further on beyond that, because it'll just incentivize more people to take their money out of the bank and put their money somewhere else where they get a higher yield. That's nothing wrong with doing that as a consumer.
Right.
But the primary focus of a bank is to hand out a loan, especially to small businesses. And if they lose their depositors, they're going to lose their ability to hand out loans.
Jim, did you see that Dallas Fed survey, 71 banks? Sort of ominous, because that was a survey since Silicon Valley Bank went under. And if that's how the big number is going to look, and I'm not sure if it comes out before the next Federal Reserve Senior Lending Officer report, if that comes out before the FOMC, but if that's the way it's going to look, then certainly there's going to be an impact. The Fed's got to be able to figure that out, though, ahead of time, right?
Yeah, you're right that Dallas Fed survey was one of the only ones that we've seen post-banking crisis. And it was a dramatic pullback on lending because the bankers don't know what's going on with their deposit base. Their deposit base is in flux. And if we see that writ large, that could be a big problem for the economy. I've always defended the Fed by saying that they don't know anything more about the economy than you or me or the collective of everybody watching this show. But they do know more about banking because they're the regulator of the banks, and that they should have known that raising rates this aggressively was going to have a negative impact on the banks. And so therefore, I think they've got to really start looking hard as to what this means for the banks, because they've obviously missed it, and now we have this problem to begin with.
Yeah, I was looking at a chart or an old Wall Street Journal article from like the 80s. The same thing happened. To your point, you should know this is going to happen. Let's talk about the market for a moment. A Wall Street Journal headline this week saying stocks haven't looked this unattractive since 2007. And of course, the article goes on to explain the reward for owning stocks over bonds is very slim or flimsy. And we've had this discussion before. Equity risk premium, for instance, which, folks, the gap between the S&P 500 earnings yield and 10-year Treasury yields at 1.59%, far low, too low. So, what does this mean for the stock market, which I think has outperformed expectations so far?
Yeah, it has. I think what it means is that if you're buying stocks now, you're not getting a deal. But as long as the economy continues to perform and earnings continue to come in, you're okay. But if you're buying stocks now and we have some slip up because of the banking crisis or some other thing, the Fed is too tight with interest rates, or fill in the blank, whatever it is, then you've got a problem because you're not getting cheap stocks. You're getting probably expensive stocks at that point. And so valuation really comes down to the environment you're in. If you think the environment's okay, there's no problem with the stock market. But if you think the environment is uncertain, then we've got an issue.
Jim, happy Good Friday. Thank you so much. Always appreciate your expertise. Have a great weekend, my friend.
Happy Easter to you, too.
Thank you. All right, I want to bring in now a monetary macro.